The market is seeing some downside right now, which is pretty common for the month of September. That tends to be the worst month for the stock market historically. So I figured I'd talk about a way to hedge your portfolio to try and improve its performance no matter what the stock market is doing. If you look at your portfolio, you should be able to find something called the portfolio delta. Each position in your portfolio has a delta value against it, and your portfolio delta is just the sum of all of those values. How it works is that a long stock position would have a delta of 1 or more. A short position would have a negative delta of -1 or less. And it's the same for options. Long put options will have negative deltas, but long call options will have positive delta. What the delta tells you is how much your position will benefit from price movement to the upside or the downside. So if your overall portfolio has a positive delta, for example by owning a bunch of long stock positions, it means your portfolio's value will benefit from price movements to the upside. On the other hand, if you have a negative portfolio delta, maybe because you're shorting stock or buying a bunch of puts, your portfolio's value will benefit from price movements to the downside. As a result, there's something you can do called delta hedging, which is where you open long and short positions that have deltas that more or less balance each other out. As a result, your portfolio could reach a delta neutral state and not have directional bias on what the market does. The most basic type of delta hedging involves buying or selling options and then offsetting that delta risk by buying an equivalent amount of stock or ETF. A covered call, for example, is a form of delta hedging because you buy long the stock, but you also sell a short call on the stock, which reduces your delta. Follow for more tips.